China's economic transformation has been nothing short of remarkable. From a largely agrarian society to a global economic powerhouse, the journey has been both swift and dramatic. Over the past few decades, the nation has witnessed unprecedented growth, lifting millions out of poverty and becoming a global economic powerhouse. This rapid ascent has been driven by massive investments in infrastructure, manufacturing, and technology. However, this rapid development has come at a cost. The relentless pursuit of growth has led to significant financial imbalances. China's economic miracle has been largely fueled by debt, and the country now faces a looming debt crisis that threatens its future prosperity. The reliance on borrowing has created a precarious situation where the sustainability of this growth is in question. From towering skyscrapers to sprawling infrastructure projects, the visible signs of China's debt-fueled growth are everywhere. These monumental structures stand as testaments to the country's ambitious development plans. But the true extent of the problem lies hidden beneath the surface, in a complex web of local government debt, corporate borrowing, and shadow banking activities. These layers of debt are intricately woven into the fabric of the economy, making it difficult to untangle. This essay will delve into the intricacies of China's debt crisis, exploring its causes, consequences, and potential solutions. By understanding the depth and breadth of the issue, we can better appreciate the challenges that lie ahead. The sheer scale of China's debt is staggering. It encompasses various sectors, from local governments to state-owned enterprises, each contributing to the mounting financial burden. According to the Institute of International Finance, China's total debt reached over 300% of its GDP in 2020, one of the highest levels among developing economies. This figure highlights the enormity of the challenge and the potential risks involved. This mountain of debt poses a significant risk to China's economic stability and has far-reaching implications for the global economy. The interconnectedness of global markets means that any disruption in China could have ripple effects worldwide. Understanding the origins and mechanics of China's debt crisis is crucial for policymakers, investors, and anyone concerned about the future of the global economy. It requires a comprehensive analysis of the factors that have contributed to this situation and the potential pathways to resolution. As China grapples with this growing challenge, the world watches with bated breath, hoping for a soft landing, but bracing for the possibility of a turbulent economic storm. The outcome will not only shape China's future, but also influence the global economic landscape for years to come. The roots of China's debt crisis can be traced back to the late 1990s and early 2000s. During this period, China was undergoing a significant transformation, shifting from a primarily agrarian society to an industrial powerhouse. Following the Asian financial crisis of 1997 to 98, China embarked on an ambitious program of investment-led growth. The crisis had exposed vulnerabilities in the region's economies, and China was determined to avoid a similar fate. The government poured money into infrastructure projects, factories, and real estate, hoping to stimulate the economy and create jobs. Massive highways, bridges, and railways were built, connecting previously isolated regions and facilitating trade. This strategy proved remarkably successful in the short term. Cities expanded rapidly, and new industrial zones sprang up, attracting both domestic and foreign investment. China's economy boomed, and the country quickly became the world's factory floor. Exports surged, and China's GDP grew at an unprecedented rate, lifting millions out of poverty. However, this growth came at a price. The rapid expansion was heavily financed by borrowing, leading to a significant increase in debt levels across various sectors. To finance its massive investment program, China relied heavily on debt. Banks, both state-owned and private, extended vast amounts of credit to fuel this growth. Local governments, state-owned enterprises, and private companies all borrowed heavily, often at the behest of the central government. The central government encouraged this borrowing to maintain high growth rates and social stability. This debt-fueled growth model worked well for a while. The continuous flow of credit kept the economy humming, and new projects kept sprouting up. As long as the economy continued to grow at a rapid pace, borrowers could easily repay their debts. The booming economy created a sense of optimism and confidence. However, this model was inherently unsustainable. The relentless pursuit of growth through borrowing began to show cracks as the economy matured. As the economy matured, the returns on investment began to decline. Projects that once seemed promising no longer generated the expected economic benefits. New factories sat idle, apartment buildings remained empty, and infrastructure projects failed to generate sufficient economic activity to justify their costs. The overcapacity in various sectors became glaringly evident. Despite these warning signs, China continued to rely on debt to fuel its growth. The government, driven by the desire to maintain high growth rates, pushed for more investment. The government, eager to maintain social stability and avoid a sharp economic slowdown, encouraged banks to continue lending, even to risky borrowers. This led to a culture of easy credit and high leverage. This led to a rapid buildup of debt, particularly in the real estate sector and among local governments. The real estate market became a significant driver of economic activity, but also a source of financial risk. As debt levels soared, concerns about the sustainability of this growth model grew. Economists and analysts began to warn about the potential for a financial crisis if the debt bubble were to burst. Policymakers faced a difficult balancing act. They needed to manage the growing debt levels while ensuring that the economy continued to grow and that social stability was maintained. The challenge was compounded by the need to address economic disparities and ensure that the benefits of growth were widely shared. The stakes were high, and the path forward was fraught with uncertainty. As China navigates this complex economic landscape, the lessons from its debt-fueled growth era remain crucial. The future will depend on how effectively the country can manage its debt while continuing to drive sustainable economic development. Local governments have played a pivotal role in China's debt accumulation over the past few decades. Barred from borrowing directly from banks or issuing bonds, local governments created thousands of off-balance sheet financing vehicles known as local government financing vehicles, or LGFVs, to circumvent these restrictions. These LGFVs became the primary channel for funding infrastructure projects, often with implicit guarantees from local governments, ensuring continued development. The rise of LGFVs fueled a surge in shadow banking activities, which grew rapidly. Trust companies, wealth management products, and other non-bank financial institutions flourished, providing loans to LGFVs and other borrowers that traditional banks were reluctant to finance due to higher risks. This shadow banking system operated with little oversight or regulation, making it difficult to assess the true extent of risks and interconnectedness within the financial system, creating a hidden danger. The opacity of shadow banking activities masked the true scale of China's debt problem for years, keeping many in the dark. As long as economic growth remained strong, investors were content to ignore the warning signs, believing in continued prosperity. However, the reliance on shadow banking created a dangerous illusion of stability, which was misleading. The lack of transparency and regulatory oversight made the financial system vulnerable to shocks and increased the risk of a systemic crisis, which could have far-reaching consequences. China's debt-fueled growth model has led to a significant misallocation of capital, resulting in a plethora of inefficient investments. Over the past few decades, the country has experienced rapid urbanization and industrialization, largely driven by an aggressive push for economic growth. However, this growth has come at a cost, as the focus on quantity over quality has led to numerous projects that do not generate sufficient returns. From sprawling ghost cities with empty apartment buildings to underutilized infrastructure projects, the country is littered with monuments to wasteful spending. These ghost cities, often built in anticipation of future demand, stand as stark reminders of the pitfalls of speculative development. The vast stretches of empty buildings and deserted streets paint a grim picture of misallocated resources. Driven by a desire to maintain high GDP growth rates, local governments often prioritized large-scale infrastructure projects that generated impressive headline figures but failed to deliver tangible economic benefits. These projects, while visually striking and politically advantageous, often lacked the necessary demand to justify their existence. The emphasis on rapid construction and expansion overshadowed the need for careful planning and sustainable development. This pursuit of GDPism resulted in the construction of countless bridges to nowhere, airports with few passengers, and high-speed rail lines with low ridership. These underutilized infrastructures not only represent wasted financial resources, but also highlight the inefficiencies in the planning and execution of such projects. The focus on short-term gains has led to long-term challenges. as maintaining these structures without adequate usage becomes increasingly burdensome. The proliferation of ghost cities is perhaps the most striking example of China's inefficient investments. These urban areas, often built in remote locations, were intended to accommodate a growing population that never arrived. The result is a landscape dotted with empty high-rises and abandoned shopping malls, symbolizing the disconnect between ambitious development plans and actual market needs. Driven by a speculative real estate bubble, developers constructed millions of apartments that remain unoccupied, creating eerie urban landscapes devoid of residents. The overestimation of demand and the rush to capitalize on rising property prices led to an oversupply of housing. This speculative frenzy has left many developers struggling to sell their properties, further exacerbating the financial strain on the real estate sector. This overbuilding in the property market has left developers saddled with massive debts and poses a significant risk to the financial system. The reliance on borrowed funds to finance these projects has created a precarious situation where the inability to generate returns threatens the stability of the broader economy. The mounting debts of developers are a ticking time bomb that could have far-reaching consequences. These inefficient investments have contributed to China's declining returns on investment. As more capital is funneled into projects with limited economic viability, the overall productivity of the economy suffers. The diminishing returns highlight the need for a shift in investment strategy, focusing on quality and sustainability rather than sheer volume. In summary, China's massive debt explosion is a ticking time bomb. The paradox of high household savings rates alongside increasing debt levels, even surpassing the average debt levels of U.S. households relative to income, adds to the complexity of the issue. When comparing total debt, including government, corporate, and household debt, China's debt burden relative to its GDP is higher than that of the United States. However, China's lack of transparency and hidden debts make the situation even more concerning. Recent statements by Chinese officials claim that the debt crisis is easing, but many experts remain unconvinced. The lack of transparency and the sheer scale of the debt make it a global concern. It's crucial for global stakeholders to monitor China's debt situation closely. Increased transparency, financial reforms, and a shift toward a consumption-driven economy are essential steps that China needs to take. As the saying goes, when China sneezes, the world catches a cold. Understanding and addressing China's debt crisis is in everyone's interest. Thank you for watching. If you found this video informative, please like, share, and subscribe for more insights into global economic issues.